Namaste. In this video, we will discuss about India's 2 that talks about the inventories, how it is valued, how it is booked as expense, etc. So we will discuss about the objective of India's 2, the scope of it, and different definitions that are required to understand the India's 2, and the measurement techniques of inventories, how it is to be recognized as expense, and the disclosure requirements in respect of the inventories. So India's 2, the objective is to prescribe the treatment of the inventory in respect of how the cost of the inventory is to be recognized, and how the subsequent expenses in respect of the inventory to be recognized. If you see any balance sheet of a manufacturing company, inventory will be a major item in the balance sheet also, as well as in PL also, in respect of the cost of goods sold. So it is a very important item that is there in balance sheet. So India's 2 talks about the determination of cost, subsequent recognition of expense in respect of the inventory, and the net realizable value, how it is to be calculated, what to be excluded and what to be included, what items to be included when we are calculating the net realizable value of the inventory, and the cost formulas that we need to use for the valuation of the inventory. Scope of India's 2, it is applied to all inventories, and there are two types of exclusion. One is the complete exclusion where India's 2 does not apply, and there are second exclusion is in respect of the measurement requirements only. So 100% exclusion is in respect of the financial instrument. India's 32 and 109 deals with the financial instruments, and the biological assets at the point of harvest are out of the scope of India's 2. So it is measured as per India's 41. And in respect of the measurement requirement, it India's 2 does not deal in respect of the measurement requirement if this inventory is held by the producer. It is if the inventory is held by the traders, in that case, the measurement requirements are also applicable. But if this inventory is held by the producer, a measurement requirement of the India's 2 will not be applicable. So, if we see in case of the agriculture products, forest products, and minerals, if these are measured as per the industry practice at the NRB, in that case, the NDS2 measurement requirements are not applicable, and these are measured at NRB when the crop has been harvested or mineral has been extracted and the sale is assured under the forward contract or government guarantee, or the active market exists and there is a negligible risk of the failure to sell. So in this case, we can measure this inventory at NRV. So this standard provides an option. So based on the accounting policy choice that industry entity has based on this index, it can measure the inventory at NRV in case of the agriculture product, forest products, and minerals, if these conditions are satisfied, or if it does not opt for the NRV option. In that case, it can also measure it on the cost. And for this purpose, the cost will be calculated as per India's 41. So for the initial recognition purpose, it will be the fair value less cost to the sale at the point of the harvest. So that cost will be considered a cost for the purpose of Index 2. Apart from it, if entity opt for the cost methods to measure the inventory, Index 2 will apply. And this exclusion is only for the specific inventory that is left. Other inventory that will be covered under Index 2. Apart from it, the commodity that is held by the brokers and traders, it will be measured at fair value minus cost to sale. So there are two types of exclusion. One is the complete exclusion, that is in regard of the financial instruments and biological assets, and there is another is in respect of the measurement requirements, and that is applicable on a specific inventories only. And in case of agriculture product, forest product, and minerals, there is a accounting policy choice. It can be measured at NRV or cost also. So, what is the inventory? It is something that is held for sale in ordinary course of business. So, it may be merchandise, it can be finished goods, and in the process of production for a sale, so it may be WIP, work in progress. The raw material that is in process of conversion of finished goods. And another is in form of the material or supplies to be consumed in the production process or in rendering the services. So it may be raw material and other spare parts. Net realizable value is selling price that is calculated based on the estimate. So we need to reduce the selling price and cost of completion of the finished goods to make it available for the purpose of sale, and the cost that is required to incur to make the sale. So NRV will be selling price, estimated selling price, less cost of completion, and any cost that need to be incurred to make a sale. And there is a similar term that is fair value. So fair value is a price that would be received to sell an asset or to transfer a liability in ordinary transaction between the market participants. So here NRV is an estimated price. This is entity specific, how much selling price it will get and how much after deducting the cost of completion and cost to make sale, where fair value is a price that would be received to sell an asset or will be paid to transfer a liability in ordinary transaction between the market transaction. So it is not, fair value is not an entity specific. So if we compare the NRV and fair value, so we will find that NRV is entity specific. So it is based on the company's own selling price and cost, where the fair value is a between the market from the perspective of the market participant. It is not entity specific and it assume then transaction is in principal or most advantageous market. Though the students those have learned and Ind AS 113 will be able to grasp this. If you have not gone through the Ind AS 113, so I will request you to check my video on Ind AS 113. So it will be easier to understand the differences also. And the objective of NRV is to determine whether inventory is carried at lower of cost or NRV. So for the purpose of calculating the carrying value of the inventory, we calculate the NRV. While the fair value is to provide a market-based management and it is not adjusted for the entity-specific intentions. It is fair value is calculated based on what the buyer will think if they enter into transaction for a particular asset or liability. So in case for the purpose of calculating NRV, we deduct selling cost and cost to completion, while for the purpose of calculating fair value, we don't deduct any selling cost and we consider transaction cost only if it is required for the purpose of calculating fair value. Transportation cost we consider. And for the purpose of NRV, market consideration, we consider the actual business environment of the entity. And in case of fair value, we consider the principal market. Or if principal market does not exist, we check for the most advantageous market. And for the valuation basis, we usually result in lower amount than fair value, because while calculating the fair value, we deduct the sell fair value is comparatively higher because we do not deduct the selling cost while calculating the fair value. But in case of NRV, we deduct the cost that is required to sell the asset. And Index 2 is applicable for the inventories, and fair value is used broadly for measuring assets and liabilities at fair value, financial instrument, PP, revaluation, etc. And if we check in respect of the standards, NRV is for the Index 2 and fair value is dealt by Index 113. Sorry. So NRV is entity specific selling price minus selling and completion cost, and it is based on the conservative measure. And fair value is as per Index 113, that is based on the market participants, it's a exit price, and there is a no deduction for the selling cost. And this is a market oriented measure. So next is how to measure the inventory. So there are some measurement rules. It has to be measured at lower of cost or NRV, and there are some exceptions that we have discussed earlier, that producer of agriculture, forest products, minerals, and mineral products are not to be covered by Ind AS 2. So it can be measured at NRV if there is a standard practice in the market. And three conditions as we have discussed earlier. And commodity of dealers and brokers, it is again to be measured at fair value minus cost to sell. And next is the cost of inventory. So cost of inventory is calculated by considering the purchase cost, conversion cost, and other costs. Those are necessary to bring the inventory to their present condition and location. So here only those costs we will consider. Those are necessary to bring the inventory to their present location and condition. Administration cost, etc., will not be considered for calculating the cost of the inventory. So here abnormal wastage in respect of material, labor or other, we will not consider while evaluating the inventory. For example, we are preparing some cars. So in preparation of those cars, there is a major wastage of steel sheets because of the malfunction of the machine. So the abnormal waste of steel that is required to process the produce the cars will not be considered while calculating the cost of manufactured product, because this is considered as a nature of abnormal. And storage cost, unless those are necessary in the production processes, so these normally cost are included in case of the wine, where the production process is like this, that it has to be stored for the years to make a particular quality of wine, etc. And administration overhead and selling costs are not included while calculating the cost of inventory. So borrowing cost is included in limited circumstances that we will discuss while we will discuss the Ind AS 23. Otherwise, borrowing costs are not included in the cost of the inventory. And if inventory is purchased on the deferred pay term, so we need to recognize the financial element as interest over the period. So let's take some examples in respect of the cost of inventory. So ABC Limited buys goods from overseas suppliers. So it has recently taken delivery of 1000 units of component X. The quoted price of component X was 1200 per unit, but ABC has negotiated a trade discount of 5%. So we will reduce this trade discount while we will calculate the cost of the inventory, because this is a negotiated price. So supplier offer an early settlement discount of 2% for the payment within 30 days. So 5% discount is in respect of the purchase, while if we check, this 2% discount is in nature of cash discount. So cash discount is in respect of the payment, not for the purpose of purchasing the inventory. So it is in nature of finance. So we will not including the purchase discount while calculating the value of the inventory. And import duties of 60 unit must be paid before goods are released from the custom. So custom duty, if you are aware, that are not in nature of recoverable taxes. So it is a cost. If it would have been GST and GST would have been recoverable, then we would have not considered this part. But custom duties are not recoverable, so we will include it while calculating the cost. So, and apart from it, ABC Limited must pay a delivery cost of 5000. So this is also a part of the cost of the inventory, because it is required to bring the inventory to current location and the condition. So current location is warehouse, so we'll consider it. So if we look at the solution, purchase price we have considered after considering the 5% discount, import duties we have considered, and delivery cost we have considered. So cost of inventory is 12 lakh 5000. Here what we have not considered is cash discount, because it is not for the purpose of bringing the inventory to current location and condition. This is in respect to the finance. Next is, a dealer has purchased 1000 cars costing 2 lakh 80,000 each on deferred payment basis as 25,000 per month per car to be paid in equal installment at year end. It is having 12 cars in the stock. Compute the cost of the inventory. So deferred payment price, if we calculate, it is 3 lakh and cash price is 2 lakh 80,000. So there is a finance element in this. So 20,000 we will book as a finance cost, interest cost, and the cost of inventory will be based on the cash price. So cost of inventory 20 cars into 2 lakh 80,000 and finance cost is this. So cost of goods sold is 980 into 2 lakh 80,000. So cost of goods sold will be this much. And this we will book in the profit and loss account. Next question is, as per Ind AS 2, selling costs are excluded from the cost of inventories and are required to be recognized as expense in the period in which these are incurred. Advise whether the distribution cost would now be included in the cost of inventory under Ind AS 2. So distribution costs are cost for delivering the material from the warehouse to the location of the customers. So this is not the cost that to bring the inventory at the present location and condition. This is the delivery cost of the inventory from the warehouse of the company to the end user. So these will not be included in the cost of the inventory. Next is about the conversion cost. ABC Limited manufacture control units for air conditioner system. Each control unit require the following: one component 1205, one component Y 800 each, sundry raw material 150. The company incur the following monthly expenses: factory rent 16,500, energy cost 7,500, selling and administrative cost 10,000. Each unit take 2 hours to estimate the production workers. Each unit take 2 hours to assemble and production worker are paid at 1300 per hour. Production overhead are absorbed into unit of production using an hourly rate. The normal level of production per month is 1000. So here if we see, we need to exclude the selling and administration cost because these are excluded and not required to bring the inventory at current location and condition. And here if we check, so component cost, two components are used, component X and Y. So we have taken the cost of it, sundry raw material also. So total cost of these three items is 2155, and then we are using 2 hours are used for assembling one product, and it is paid at a cost of 300. So 600 rupees will be used here, and production overhead, fixed for production overhead will be allocated based on the normal level of production. So 16,500 is a fixed cost. Energy cost is also fixed cost. So divide by 1000, that is a normal capacity level, and per unit assembly required 2 hours. So based on the average 48 hours, 48 rupees are calculated for one unit. So total cost will be 2803. So next is about the joint product. When we are producing something, so sometime in a process, more than one products are produced at a time. So it is called either a joint product. So cost is allocated if conversion cost cannot be directly traced. If it can be traced directly, we need to use the actual conversion cost, and if cannot be traced, then it is allocated on rational and consistent basis. So common method may be at the split point when products become separately from the main product or at the completion of the product. So byproduct are usually immaterial. So because of not material, they are valued at NRV. And this NRV is deducted from the cost of the main product, because if we do not deduct, it will result in overstated of the main inventory. So whatever is the NRV of the joint product that we have come across during the production process, we need to we need to reduce the cost of the main product by this net realizable value of the byproduct. So in case of the joint cost allocation, we need to use the relative sale value, and byproduct we need to measure at NRV and deduct from the main product if it is immaterial. Let's take one example. if in a manufacturing process of Mars Limited, one byproduct BP emerges beside the two main product MP1 and MP2. Apart from scrap, detail of the cost of produces are as under. Raw material we have used of 1,50,000, wages 90,000, fixed overhead 65,000, and variable overhead 50,000. And there are two main product PP MP1 and MP2 of 5,000 units and 4,000 units. Closing stock is given, and BP, that is a byproduct, has been produced of 2000 units. So average market price of MP1 and MP2 is given 60 and 50. Byproduct is sold at 20 rupees per unit. There is a profit of 5,000 on sale of byproduct after incurring separate processing charge of 8,000, 2,000. 5,000 were realized from the sale of the scrap. So we need to calculate the value of closing stock of MP1 and MP2. So first we need to calculate the NRV of the byproduct. So this is given that it is to be sold at 20 rupees per unit. So 2000 units were produced at the rate of 20, 40,000 are produced, and we have incurred 8,000 as a processing charge and packing charge of 2000. So we need to reduce 10,000. That is the cost to sell the byproduct. So net realizable value of the byproduct is 30,000. Now we calculate the cost of the conversion of uh, for allocation between the joint product. So total cost is raw material, wages, fixed overhead, and variable. Then we need to reduce, as we have discussed, the NRV of the byproduct. So 30,000 we will reduce out of it. So, and the sale value is 5,000. Scrap sale value is given, also given. 5,000 were realized from the sale of the scrap. So total joint cost that we need to include after reducing the NRV of the byproduct and the scrap value is 3,20,000, and it is allocated based on the sale price of the MP1 and MP2. So per unit cost is 38.4 and 32. So closing stock that is given in the last in the question is 250 for MP1 and MP2 is 100. So is multiplied, units are multiplied by the cost per unit, and this is the value of the closing stock that we have calculated. Next is about the capacity loss. So when we are producing something, manufacturing industry need to define its normal capacity. And normal capacity is expected production that we need to achieve over on an average or seasons under the normal consideration. So while we are calculating the normal capacity, we need to reduce the number of holidays, the period for which the plant will be closed, and this is based on the how much we expect to produce in the year. So based on that, the normal capacity is calculated. And the conversion cost we can divide in two parts. One is the variable cost that will increase or decrease based on the level of the production, and there are some costs those are not going to reduce, are not going to change based on the production. For example, the depreciation cost, this is a fixed cost, you have to incur the depreciation irrespective of your level of the production. So if a variable cost we need to allocate on the inventory irrespective of the level of the production, and in case of fixed cost, if the actual capacity is greater than the normal capacity, in that case we need to load on the inventory. For example, actual production capacity that we have produced is 150 and the normal capacity is 100. So in that case we will allocate the fixed cost to 150 units, because if we do not allocate on 150, if we allocate on the 100 only, in that case it will not give a correct result. And if it is the opposite case, when the normal capacity that we decide is higher as compared to the actual capacity. For example, the normal capacity that we decided at the beginning of the year is 100, that we are going to produce 100 units per annum, but we produce only 80. In that case, we need to for the 20% of the decline from the normal capacity to actual capacity, the fixed overhead of 20% we need to book as a capacity loss. And if we do not book it as a capacity loss, it is going to result into overstated of the inventory valuation. So difference, if there is a normal capacity is higher as compared to the actual capacity, in that case, the decrease in the production we need to book as a capacity loss. And if the actual capacity is higher, then we need to load it on the inventory. So if we calculate the capacity loss amount calculation logic, it will be fixed manufacturing amount multiplied by current capacity minus actual capacity divided by the current capacity. So based on it, we will debit the capacity loss account and will decrease the manufacturing expenses. So let's take some example in respect of this. A business plan for the production overhead is 10 lakhs per annum. Normal level of production is 1 lakh unit, but due to supply difficulties, the business was only able to make 75,000 units in calendar year, and other cost per unit were 120. So we need to calculate the amount of overhead to be expensed during the period. It is asking for the amount of overhead that we need to expense. So if we check, the normal level of production is 1 lakh. So there is a decrease in production. Actual production that we have achieved is only 75,000. So there is a decrease of 25%. So fixed overhead are 10 lakhs per annum. So we will reduce the fixed overhead by 25%. So the amount is not to be absorbed by the inventory is 2 lakh 50,000. 25,000 of 25% of the fixed overhead. So So in question it is solved in a different way. They have taken the other cost 120 and the production overhead they have calculated based on the per unit. So they have calculated it is 10 rupees per unit. So unit cost they have calculated 130. So the total production is 10 lakhs and amount absorbed into inventory, only 75,000 is produced. So based on the 75,000 into 10. So it is 7 lakh 20,000. So amount not absorbed by the into inventory is 2 lakh 50,000. So I have calculated in different way. I have calculated simply that it is production capacity is reduced by 25%. So 20. So total overhead multiplied by the reduction in the capacity 25%, 2 lakh 50,000. Answer is same in the both cases. So whatever way you feel it is easy to memorize, you can use any of the method. The answer will be the same. So there are some cost measure techniques that we need to use for the convenience and to provide approximate cost of the inventory. We may use the standard cost method. So it is mostly used in manufacturing, but the result should be equal to the actual cost of the inventory. And another method we can use is the retail method, and it is used where retailers is having large turnover of inventories of similar items. So we can, for example, in grocery markets, we can check there are a lot of items, so it is difficult to manage the inventory. So the option is given to use the retail method where we use the sale value minus gross margin percentage. So we need to take into consideration inventory that has been marked while calculating the retail market. If there is some inventory that has been already written down to the net legal value, so we are not supposed to consider that portion again. And for other inventory, we need to use the sale value minus the gross margin. And for the purpose of standard method, we need to take into consideration the normal level of material and supply level, labor and capacity utilization. And for standard method we need to review and revise regularly to change to the changed condition. So in normally the drawback in standard method is that we need to calculate the actual cost also vice versa to check whether it is correct as per the result as per the standard method is equal to the actual cost method. So let's take one example of it. Mars Fashion is a new luxury retail company located in Lajpat Nagar, New Delhi. Kindly advise the accountant of the company on the necessary accounting treatment. One of the company's product line is beauty products. So the particular cosmetics such as the lipstick, moisturizer, and compact makeup kits, the company sells hundred of different brands of these products. Each product is quite similar and is purchased at a similar price and has a short life cycle before a new similar product is introduced. The point of sale and inventory system is not yet fully functioning in this department, but it is confidence of selling price has reliably informed you that the company on average make a gross margin of 65% on each case. So in this case, as the inventory system is not fully functioned and it is difficult to actual calculate the NRV of the product, so India 2 gives an option for retail method to be used. So here retail method can be used. And in second case, Mars Fashion also sells handbag. The company manufacture their handbags as they wish to assure of the quality and craftsmanship which goes into each handbag. The handbags are manufactured in India in the factory which has made handbag for last 50 years. Normally, the Mars manufacture 1 lakh handbag in a year in their handbag division, which use the 50% of the space, 15% of the space, and overhead of the head office factory. The division employee 10 people and is seen as being an efficient division within the overall company. So, in accordance with AS2, explain how the items in B should be measured. So, in this case, the standard method can be used if the results approximate the cost. That is the main condition that in standard cost, you need to check whether the result as per the standard cost is equal to the actual result or not. So these are two techniques that are given by India's 2 to easy of uses. Else we need to use the cost formulas, and if the while using the cost formulas, we need to check whether the inventory is interchangeable or produced and segregated for a specific purpose. If inventory is produced for a specific purpose, in that case, we need to use a specific cost method. And if it is not produced for the specific purpose, in that case, we need to use the cost formulas. Either we can use either FIFO or weighted average cost. LIFO is not allowed. And we need to use same cost formulas for all the inventories. Those are having similar nature and usage. And the cost formula cannot be decided based on the geographical location of the inventory. Formula, we may use different formulas, but it can be based on the nature and uses. It cannot be based on the geographical location of the inventory. So let's take one example of it. State whether an entity can use different formula for inventory at different geographical location having similar nature and use to it. So answer is no. We cannot use. We can use only FIFO and weightage, and entities shall use the same cost formula for the inventories having, as we have discussed, nature and usage. If these are held at different geographical location are of similar nature and use of the inventory, use to the entity, different cost formula cannot be used for the inventory valuation purpose. So different inventory formulas can be used only for the usage and based on the nature and usage. It cannot be based on the geographical location. So next is what the NRV is. If NRV of the inventory is lesser than the cost, it may be because the product is damaged, it is defective, or there has been decrease in the market demand. There may be change in the technology of the product, so there is no demand of the market. So we need to write down the inventory to the net realizable value. And there are two options. It can be done item wise item, and it can be based on the group of item also. But it will be used, group item method will be used if there are similar in nature and they are same product line, purpose and market area, and not practicably separable. Otherwise we need to use the item wise item method. And write down of inventory is not allowed by the broad classification that all the finished goods we cannot combine. So three conditions we need to use if we are opting the group method. Otherwise, it has to be done item wise, item basis. And evidence to NRB, it is the based on the most reliable evidence at the reporting date. And the post period event we need to consider if the condition exists at the balance sheet date. And the purpose of inventory is NRV depends on the intended use. If the we are having a similar nature of the items, for example, I am having 1000 LED, and if I am having firm contract for 500 LCD, and that is more than the cost price of LED, so I am not going to book a NRV loss for 500 LEDs. Therefore, that I have a firm contract. And if the NRV is lesser, the market value has decreased. So for the differentiation between the cost and the market value for the 500 remaining quantity for which I don't have the firm contract, I need to recognize the NRV loss. And material and supplies, these are not written down if the final product is expected to sell for more than the cost, and if final product otherwise is subjected to the devaluation of the inventory, that in that case we need to recognize, we need to book loss on material and supplies also. And in these cases the replacement cost is the best NRV method. So material and supplies will be uh, subjected to devaluation only in case if the final product in which those are being used are going to be sold at lesser than the cost. And in case of the reversal of write down, we need to reassess the NRV at the end of the each period, and if the condition improve, we need to reverse the devaluation that we have booked, and reversal will be limited to the original devaluation that we have booked, and the carrying amount again will be the cost or revised NRV. So for the purpose of NRV, it is selling price minus cost of the completion minus cost to make sale. And if NRV is lesser than the cost is greater than the NRV, then we need to book the devaluation loss. So this will be accounting entries. When inventories are sold, we need to book the cost of sale and reduce the inventory. And when inventories are written down, we need to book the devaluation, and we need to book the allowances for the inventory valuation that will be offsetted from the inventory while making the balance sheet. And if there is a reversal of devaluation, then we need to reverse the inventory devaluation account and need to book the gain in devaluation. So let's take few example on NRV. Requirement whether the following cost can be considered while determining the NRV. First is the cost of completion of work in progress. Yes, it can be considered. Trade discount expected to be allowed on sale. Yes, discounts are considered while calculating the NRV. Cash discount, not. These are not considered for the purpose of valuation. So first is cost of completion. It is considered, and trade discount should be deducted to determine the estimated selling price, and the cash discount are not included here. Next question is ABC Limited manufacture and sales paper envelopes. The cost of the envelope was 50 per bag per pack, and during the final audit, the auditor noted the subsequent sale price has decreased from 50 to 40. Furthermore, inquiry reveals that during the physical stock take, a water leakage has created damage to the paper and glue. According in the following week, ABC Limited has spent a total of 15 per pack for repairing the repairing and reapplying glue to the envelope. So the cost is 50, but the NRV is 40. And further, this for to coming up to this NRV, we have to incur to make it sellable. We need to incur the 15 rupees for the repairing of the damaged product. So we will reduce this cost also. So 40 minus 15, it will be 25, and cost is 25, so the devolution will be booked by 50%. That is 25 per pack. We need to book a devolution. At the end of the financial year, company P has 100 units of inventory on hand, recorded at a carrying amount of 10 rupees per unit. The current market price is 8, at which the unit can be sold. P Limited has a firm sale contract and it can sell 60 unit at rupees 100. So for 60 rupees, it is having firm contract of 12, that is greater than the carrying amount cost, that is 10. So for 60 units, it is not supposed to book a devaluation, although the current market price has reduced to 8 because it is having the firm contract and the inventory can be realized at a rate of 11 for the 60 units. And for remaining 40 units, it need to book the devolution. So 10, current market price is 8 and increment selling cost is 1. So net realization will be 8 minus 1, that is 7. So 10 minus 7, 3 rupees per unit will be the devolution loss. So remaining inventory will be revalued. 40 units will be valued at rupees 7 and 60 it will be at 10, because there is no devaluation loss here because the company is having the firm contract at 12. So NRV is 12, cost is 10. So lower of NRV or cost, so 10, it will be cost is lower, so it will be booked as 10. No devaluation will be booked in this case. Next is a business size 4 items of inventory. A count of inventory is established that amount of inventory currently held at cost is at 4 as follows. So inventory item A cost is 8,000 and estimated cost is 700 and selling cost is 500. So NRV estimated is 7,300. So in this case, NRV is lesser than the cost. So we will book it as a at a cost of NRV, whichever is lesser. So in similar other cases, we need to compare the cost and NRV, and whichever is lesser, based on that, we need to value the inventory. So in this case, it will be booked as 14,000. In this case, it will be booked in for 16,000 as the NRV is higher. Similarly, in this case also NRV is higher, so it will be booked at 6,000. So only in one case, case A, item A1, it will be booked at NRV because here the cost is higher. So next is opening stock of finished goods 1000 kg, 25,000, raw material 1100 kg, amount is 11,000, and we have further purchased 10,000 units of 1 lakh. Labor we have incurred 76,500. Overhead, fixed overhead are 75,000. Sale that we have done of 10,000 units. So it is 2,83,000. Closing inventory is given raw material 900 and finished goods 1,200. The expected production for every year is 15,000. Okay. So this is a normal capacity that is given in the question, and due to fall in the market demand, the sale price of the finished goods was 20 per kg and the replacement cost of the raw material is 9.5 per kg. Calculate the closing inventory as on the date. So in this case, we have not given how much we have produced. We are given opening stock of finished goods, closing stock of finished goods, and the units that we have sold, that is 10,000. So we need to calculate the what is the production. So sale plus closing stock minus the opening stock. So 10,200 is the kg is the production quantity. So now we need to calculate the cost of this production. So here it is given that normal capacity is 15,000 kg. So but we have calculated only 10,200 kg. So this is subject to the capacity loss because the actual capacity is lesser than the normal capacity. So we need to calculate how much raw material we have consumed for producing 10,200. So it is 10,200 into 10 per kg. So because we have purchased 10,000 and amount is 1 lakh. So 1 lakh 2,000. Labor we have given 76,500. This is a variable cost. So total we will consider, and fixed overhead we will calculate 5 rupees per unit. So overhead we need to fix overhead we will allocate up to the normal capacity only, actual capacity, because it is lesser. So 10,200 into 5, 51,000, and for remaining amount 75,000 minus 51,000, it will be booked as a capacity loss. So total conversion cost will be 1 lakh 2,000 plus 76,500, that is labor, and 51,000 only out of the fixed overhead. So total cost will be 2,29,500, and cost per kg of finished goods 2,29,000 divided by 10,200, 22.5. Now we need to check the NRV and cost. So closing raw material is 900 kg, that is 10 kg, and NRV is given 9.5, so that is lower than the cost. So we need to use the replacement cost, and so it will be valued at 8,550. And in case of closing stock, the cost is 22.5. However, selling price is 20. It is given here that it is can be sold at 20. So we need to use the 20 selling price because it is lower than the cost. So it closing stock will be booked at 1200 into 20. So the invent in this case, the devaluation loss will be booked in respect of the raw material also, because the final product for that we are using is going to be sold at a lesser value. Selling price is 20 and the cost that we have calculated is 22.5. So in this case, the finished goods as well as the raw material is subjected to the devaluation. Next is Sun Pharma Limited, a renowned company in the field of pharmaceuticals, has the following four items in the inventory. Cost and NRV is given as below. For A, cost is 2,000, NRV is 1,900. Similarly for B, it is greater. C is also NRV is greater, and D is, in case of D, it is NRV is lesser than the cost. So two items are subjected to the devaluation. So if we go item by item, it will devaluation will be booked in case of A and D. So if we check on group basis, it will be total basis it will be 14,550. But when we are checking the group, we need to check the conditions when we can use the group method for devaluation. And India has to ask us to disclose out the accounting policies for measurement of the inventory, total carrying amount of the inventory in classification of raw, WIP, and finished goods. And inventories, those are carried at fair value less cost of sale, and amount expensed at COGS. If we have booked the devaluation loss and if we have done the reversal of devaluation loss, we need to provide it with the regions, and inventory that we have placed at security we need to disclose in our financial statement. So this is all about the Ind AS 2. If you need any clarification on the topic or you need to discuss anything about it, you can use the WhatsApp number given on the screen. Namaste. Thank you very much for watching.